come on up, who's from the IFS. A few things for you to think about while Paul's on his way up here and joining me. Please start thinking about questions. Paul's going to talk for about half an hour or so, and then he's going to take questions. You can submit questions the usual way, with your hand in the air, or indeed using the conference app. And I'm sure you've all downloaded the conference app, so dig that one out and have a look at it. This is the first of our live streamed sessions at this conference. Hello to you if you've logged on and you're watching us from home. Paul's going to stay with us after this. He's going to go down to the Learning Hub. So if you don't get the chance to ask a question, then you'll have a chance during the tea break to do so. Paul's going to speak for about half an hour. Paul, when you do, perhaps you could tell us about your win on University Challenge as well.
I'm very happy to. We won. First time ever that the other team scored 0 as well.
Oof. Was that because your finger was too fast on the buzzer?
It's because I had Frank Cottrell-Boyce on my team. He got everything right. It was brilliant.
Well done.
Genius man.
After you then.
Right. Thank you very much. I'm afraid that my life will never get as good again as winning University Challenge, but this is a close second. Perhaps not for you. Not always the best idea to ask an economist to give the after lunch talk if what we're looking for is something slightly upbeat, but I will do my best. I think I'll fail. I think we're on the brink of things that aren't necessarily good. And indeed, we have gone well past the brink of things that haven't been terribly good. You should be familiar with this chart. If you've seen me speak before, the rest of my charts are new, but this is one that I use all the time. And it really is to illustrate just how different and extraordinary the last decade has been relative to where we might reasonably have expected. We heard that Alistair Darling is going to be here on Friday. Well, that dotted line at the top, in his 2008 budget, that's broadly what he was forecasting would happen to the economy, that it would continue to grow by about 2% a year each year going forward. The bottom line underneath is what's actually happened to the economy. And we've got a gap, 14% gap now, will be a 20% gap between what we might have expected and what's actually happened. That's £400 billion lost forever from the economy relative to what we might have expected. Now, I think if you want to understand pretty much anything about what's happening in politics at the moment, and also in investment and much else, this is the chart that really explains it. And I think, well, not explains it, describes it is probably a better way of putting it. And when you're thinking of investment, obviously, the big question is this the new normal, or is it going to change? Because obviously underlying this is a whole series of things, including extremely low interest rates, and probably, therefore, low returns on many other things, potentially for a long period to come. And what does that mean? That means, of course, that for the current generation of savers, they just have to save a huge amount more than the previous generation in order to make the sorts of returns and get the sorts of incomes in retirement than they did in the past. And indeed, if you look at the safe return, it is essentially impossible to save enough to have a decent income in retirement if things carry on as they have been, and if you're looking at investing in safe or safe-ish assets. And that's really what this chart is showing. If growth is very low, then returns are likely to be very low into the future. I don't know whether the future will look like the last 10 years or whether it will look like the 50 years before that, and nor does anyone else. But that underlies a lot of those problems. And just to underline what a not great decade it's been, and we are very focused, I think rightly, on the future at the moment, but I think in order to understand the future, it kind of matters to understand the past, just to illustrate that. What I showed you just now was national income in total. It's gone up by about 10% since 2008. This is national income per person, because the population has grown, national income per person has grown rather more slowly. It's barely ahead of where it was in 2008. And just to show you how that compares with previous periods after recessions, that's what happened after the 1970s, 1980s, 1990s recession. We're wildly behind that. We're also a long way behind the 1920s and the 1930s. This really has been the worst decade for growth pretty much in history. I mean, you go back, the Bank of England will take you back into the 1800s and the 1700s with various bits of data that it's got. But this has been an absolutely unprecedented decade. And again, when I come to say something about what the future might look like, it's really important to put it in this context, because when I say the future might not look very good, it's on the back of things that really haven't looked very good for a decade or so. And that, again, I think if you think of where we are in terms of politics, if you think of trust, not just in you guys, but in politicians and indeed economists, this will give you a pretty good understanding of why that trust might be missing, and not without good cause. So those are fairly abstract sorts of numbers. That's national income per head. What's driven that? Well, what's driven it has been productivity. And again, this is a description. Is this an explanation? Well, you then need to explain what's been happening to productivity. What's happened to productivity over the last decade? It's barely grown. In the long run, productivity isn't everything, but it's nearly everything, as the famous economics quote goes. And if productivity isn't growing, then incomes aren't going to be growing, prosperity isn't going to be growing. That's what's happened. So what I'm going to bring up now is what the forecasts were for productivity at each budget and autumn statement over the last 10 years. Unfortunately, see, economists can be cheerful, it's just they're wrong when they're cheerful. Unfortunately, the reality hasn't come close to matching the forecast. So why has growth been so poor? Well, growth has been poor because productivity hasn't picked up. Productivity has flatlined against a history, again, of it growing by about 2% a year, year on year, for the 70 years or so, or 60 years or so, up to 2010. We are in a new period. Now, again, will the 2020s look like the 2010s, or will they look like the 2000s, the 1990s? I don't know, but we have been consistently disappointed when thinking that productivity might return to doing what it used to do. What does that mean for people, their earnings? Well, that's, if anything, done even worse. Earnings are still, I mean, this is, I think, the most extraordinary statistic in terms of the last 10 years. Average earnings today are below where they were in 2008, the first time for hundreds of years when that has been true over a decade. And again, in thinking of your world, thinking of money that is available for saving, thinking about the impact of auto-enrollment and increasing the amount of money going into auto-enrollment, that's holding down, or has the potential at least, to hold down earnings. Further, with the effect, as you'd expect, that incomes also haven't been growing. Incomes have been growing a bit more than earnings because actually the incomes of people over retirement age are higher today than they were a decade ago. But I mean, literally the average income growth in the 40 years to 2007 was 2% a year. It's been about 0.5% a year since then. So again, if we're thinking as we are about the brink, about Brexit, about what might happen in the future, about how growth might be worse, it's off the back of this. It's off the back of, again, very good reason for people voting, thinking things haven't been working terribly well over the last decade or so. So that's that's a large part of what's been happening. There is some good news. Employment growth has been very, very rapid. Again, the dotted lines here are the forecasts. The solid line is the reality. The reality has continually outstripped the forecast in terms of employment. We have the highest employment rate that we have ever had, particularly boosted by the number of women in work. And one of the reasons why the British economy has sucked in immigrants from the European Union, and more recently in the last 18 months or so, not immigrants from the European Union, but immigrants from the rest of the world. We do have a strong labour market in terms of the number of people in work, if not in terms of how much they're earning. One of the extraordinary aspects of this, though, is that whilst incomes have faltered, and they faltered again post-referendum because inflation rose, as inflation rose, earnings didn't keep up, so incomes have faltered again in the last 2 or 3 years. Consumption, people's spending has continued to rise, and we've got this remarkable fall in the savings ratio over the last 2 or 3 years. So if we're thinking of the brink, if we're thinking of challenges, if we're thinking of the future, what happens with a savings ratio which is that low already? If you've got a chancellor that wants to boost the economy, if we get a problem with Brexit, he's not going to want to necessarily boost the economy for very long by encouraging people to spend more, because that's going to take that savings ratio down even further in the face of very low real income growth. So we have a savings ratio which overall has been doing extraordinarily poorly over the last 2 or 3 years as people's incomes have not kept up with their expectations. What about economic growth? Well, you can see here that the solid line is UK economic growth since 2015. The shaded bit is it encompasses all G7 economies. You can see that the UK was doing reasonably well towards the top of the G7 up till the middle of 2016, and certainly by the middle of 2018 was towards or at the bottom of the G7. So that's what's happened up till now. I'll say something about where forecasts are in a second. But one of the things I think is probably the most worrying for the next few years is what's been happening to business in business investment. So the red line here is what's happened to business investment in the UK since 2008. The upper bit of the chart is what's happened in the period after previous recessions. What you see is that usually about this time, about 7 or 8 years after recession, business investment starts to really pick up. That was certainly the forecasts back in 2016. It's been the experience actually of most other countries since 2016, but it has flatlined. If anything, the most recent figures suggest that business investment has been falling. Now, actually, this underlies a lot of things that I'm going to say to some extent. This is actually quite good in the short run for tax revenues because it increases corporate tax. In the long run, it's bad for growth, and it's clearly bad for long-run tax revenues. And just to show you where our business investment is relative to the rest of the G7, at the moment, as you can see, the red line is just dipping below 0. It's not growing, it's falling in the UK. It's growing faster in all of our other competitor economies. Now, that's related, of course, to the uncertainty that we face in the UK economy, and to some extent to the extent to which British businesses are increasingly investing elsewhere because of the uncertainty. If you're talking about the brink, you want to avoid the brink, and you certainly want to avoid uncertainty where you can. So that's where we are at the moment on business investment. I'll flip over that one. That was just saying that despite all of the insults that have come flying economists' way, actually economists got it pretty right. The Bank of England, the National Institute of Economic and Social Research, the London School of Economics essentially projected what would happen to growth post the EU referendum pretty accurately. They got the timing wrong. They thought that growth would dive and then pick up. What actually happened was that growth carried on and then slowed down. But today we are roughly where the Bank of England and others projected we would be immediately following the referendum. We've lost about 2% of national income relative to where we might otherwise have been. I think there is essentially consensus about that. Where are we going? Well, this is the most recent set of forecasts from the Office of Budget Responsibility, published in the October budget. We will see their most recent or their newest forecast next week in the spring statement, and I'm going to come on to say a little bit about the spring statement in a moment. They're essentially forecasting growth will be about 1.5% a year for the next several years. Now, this is all predicated on what they call a smooth, soft, easy, straightforward sort of Brexit. This is their forecast going forward. Probably those forecasts will be reduced next week. We know that the Bank of England has reduced its forecast for 2019 from 1.8%, which is what they thought would happen when they made their forecast last August, to 1.2%, which is their most recent forecast last month. Probably the OBR will follow suit. Whether that will flow through into lower growth in future years, we don't know. But again, relate that to the figures I showed you earlier. 1.5% growth a year is way below the average growth that we've seen over the 50 years leading up to 2008, but it's coming off the back of a decade of way below normal or average growth. So again, if the economy was picking up, it was making up any of the ground that we'd lost, we'd be talking of 2.5% or more growth. We're not even looking at growth at its long run average. Now, there's a lot of things going on here. There's what's happening in the UK economy. A lot of this is driven by our very poor productivity performance. Some of it's driven by uncertainty over Brexit. But there are other things going on in the rest of the world. And one of the things that has helped us actually over the last couple of years is the rest of the world's been doing pretty well. The Eurozone's been doing pretty well. China, the emerging economy's not too bad. The US is on a bit of a fiscally stimulated boom over the last 2 or 3 years. A lot of that's coming to an end. The EU, the Eurozone economies have been slowing down pretty surprisingly and pretty substantially over the last 6 to 9 months, and that has the potential to have a negative impact on us. The Chinese economy is slowing down and projected to slow down, as are some other emerging markets over this year. That could also have a negative effect on us. We've been helped by a growing world economy over the last couple of years. There is a danger that that will peter out this year. The US is still being mooted, being pushed on by the fiscal loosening, but that will come to an end at some point. Some of what's going on with the Bank of England forecasts are their concerns about what's going on in the rest of the world. One of the reasons they've come down, one of the concerns which I think we'll see expressed by the OBR next week in the spring statement forecast is something similar. Obvious point, Brexit of course creates all sorts of uncertainty. All of the forecasts I've given you, as I've said, assume some kind of smooth Brexit. I mean, the truth is, certainly the OBR, they keep each year, they say, we had to make some assumptions about Brexit, and we asked the Prime Minister and the Chancellor what Brexit was, and they came back and said, Brexit means Brexit, and referred us to a speech the Chancellor or the Prime Minister gave recently. So they make a slightly unfair to say they put a finger in the air, but they certainly haven't got a clear model of what will happen post-Brexit. But this is not based on a no deal or anything like a no deal. So lots of uncertainty about what will happen. We know that certainly in terms of the fiscal arithmetic, we will have roughly the same net fiscal contributions in a couple of years' time as we would have done. So that's not helping the fiscal numbers. Further on down the road, our net contributions will be smaller, but this is small beer. These are 8 to 10 billion a year net, which is already less than what we've lost from lower national income. So going forward, again, if you take the average of the forecasts from the bank, the National Institute, and elsewhere, the sort of deal that we've got might mean that we're about 4% worse off in the long run than we would have been had we stayed within the EU. 4%, over a long period, it's not going to make a vast difference to the economy, but 4% of national income is quite a bit of money. What would no deal look like? We don't know what no deal would look like. We don't have any forecasts, really. The OBR essentially said, look, we can't model no deal. If we look back in history, the nearest sort of self-inflicted disaster we can see is the sort of 3-day week in the early 1970s, and that by itself immediately took 3% off national income. They're not saying that's what no deal would do, they're just saying it's not really amenable to short-run modelling. In the long run, there seems to be broad consensus that it might have double the sort of effect that the kind of deal that we have at the moment. So maybe, and these are subject to massive margins of error, maybe taking 8% off the economy. These are the sorts of sort of doomsday scenarios that the Bank of England ran back in the autumn. This is not a forecast. These are their scenarios. They're suggesting that some kind of particularly bad no deal might take us into quite a deep recession. The short run might lose us something like 8% of national income in the longer run. They're very much at pains to say this is not a forecast, but it's the sort of scenarios that they were running to look at the robustness of the banking system in that world. You can see if those scenarios are anything like right, the difference between the sort of current trajectory and a no-deal trajectory is pretty big, and it's pretty big in the short run. And to go back to the theme, we may be on the brink of something pretty big. But again, let me be clear. First, they are very clear this is not a forecast. And secondly, massive uncertainty about what the actual impact would be. Let me say something about trade now. So one of the effects, of course, of moving out of the European Union and all the trade relationship we have with them and potentially with the rest of the world is to change tariffs and other barriers at the border for different goods. So what are these tariffs? What are the scale of these tariffs? So this chart takes actual tariffs, that's the blue bit, and so-called non-tariff barriers. That's the tariff equivalent of the costs of moving things through the border if you don't have something like the single market. So the first thing to see here is that tariffs are not the important bit of this. Unless you're in the food and drink or agriculture or clothing industries, and to some extent transport, tariffs are not the important bit of trade barriers. We hear lots about tariffs for most of the economy. They're really not very important. They matter a lot if you're a farmer. They matter almost not at all if you're in finance or in most of the service sector. The red bits are the things that matter there, and they're much less certain. Again, these are just put here as numbers. The red bits are the non-tariff barriers. They're much less certain. They're also much more important across the whole of the economy. So if we did move to World Trade Organization type tariffs and non-tariff barriers, what would be the effect on the value added in the economy? Well, the one-off effect right across on average is relatively small, but it's very variable across different industries according to the importance of those tariff and non-tariff barriers. So if you're in the transport, clothing, chemical sector, this is a big, big impact on your bottom line. These are things which have big tariff barriers, big non-tariff barriers, and particularly important, things move across borders a lot. Those industries are hard hit. There are some industries which might actually benefit. So if you're a farmer and you get protective barriers put up to support you, it might actually be good for you. Bad for the consumer, but maybe good for the industry. And then there are the ones where there's a lot of uncertainty. The two red lines here are for finance, for wholesale and retail, which are big chunks of the economy, which you can see from the black diamonds above them, and potentially reasonably significant. Lots of uncertainty here, particularly for the finance sector. The impact may be bigger than is shown here. We're really very hard to estimate. Let me finish by saying something about next week, and not the thing that everyone else is thinking about for next week, which is the various meaningful and meaningless votes that we're going to have, but the spring statement and potentially the spending review. We now only have one budget a year. We have a budget in the autumn. You've probably forgotten about the last several budgets because there's been absolutely, with one exception, been very little of interest in them. I think the Chancellor's got some really big choices to make this year that aren't Brexit or aren't necessarily Brexit choices, and they come in the spending review. We will have a spending review this year, and that will be about setting spending for perhaps just the next year, perhaps for the next 3 years. So what's he going to do? And this could be the defining non-Brexit set of decisions of this Parliament. He's in a world in which borrowing is essentially under control, and I'll show you some numbers suggesting that. So he really could decide to significantly unwind austerity. Or he could decide that he sees the significant levels of outstanding debt to be too much of a constraint on that, and he really doesn't start to unwind austerity. That's the big choice for this year, I think. Of all of the choices this government's going to make that aren't about Brexit, the big choice is, do they really move away from austerity, or do they stick to their guns and say, we're really concerned about the level of the debt and we're not going to make a big move in that direction? And that is a genuine economic choice. And just to illustrate how, in a sense, we have got the deficit under control, it was £140 billion. It was 10% of national income. Last year it was down to 40 billion. This year it's going to be down to around 20 billion. It's at its lowest level since the early 2000s. The deficit is now significantly below where it was pre-crisis, about 1% of national income. The deficit is now genuinely quite low by historic standards. And so the last line on here, October 2018, this was the forecast of the deficit in the budget back a couple of months ago, down to £20 billion, absolutely trivial, tiny by historic standards. Actually quite a remarkable achievement in many ways. As you can see from these lines, that's happened a lot slower than initially intended, and it's happened slower essentially because the economy's grown a lot less quickly than expected, but it's down at really very low levels. How have we got there? Well, we've got there largely partly through some tax increases, but mostly through spending cuts. Two departments have seen significant increases in their spending. International development, which is a small total, and health, which is a big total. And I'll come back onto health in a moment. All other departments have seen big cuts. This is historically unprecedented. You look all the way back through history, you literally never see cuts like this in departmental or public spending over a decade. On top of this, there's been something like a 20% cut in spending by local government on everything from social care to libraries and provision of waste disposal services. So 20% cut in local government spending as well. So a huge set of reductions. And the big question again for the spending review is, does that get unwound? Does that get in any degree reversed? Well, one clue might be to look back at what the Chancellor did in the autumn. He was lucky in the autumn. The OBR said, look, we think borrowing is going to be 20 billion a year less than we thought back in the spring. So the public finances are getting better, and they're getting better quite quickly. And we'll probably see some more good news on the public finances next week. So borrowing went down by 20 billion, forecast at 20 billion in the short run, and essentially the Chancellor spent it all. So that's been the pattern of departmental spending over the last decade. And last March, it was supposed to continue gradually downwards. In October, you can see, so I said there was this big change, this big choice. Does he unwind austerity? Well, it looks like he made that choice in October, doesn't it? I mean, that is, if you're looking at departmental spending on public services, that looks like a real change from a period of significant reduction and a plan for sort of flat, and then it goes up really quite sharply. But it's not quite as simple as that. All of that money is going to the NHS, 20 billion additional announced in October. Extraordinary change in the shape of the state. 40% of public service spending will be health in the mid-2020s, up from less than a quarter in the early 2000s. Consequence of that, of course, is less money for everything else. So we know that health spending is going to go up enormously, and we know that defence and overseas aid spending is protected. That does actually mean still, even after October, there are still cuts coming in real spending on the other services, about 2 billion of cuts on current plans over the next few years, 5 billion if you're looking at that on a per capita basis, 11 billion if all you want to do is keep spending constant as a share of national income. So what does that mean? That means that if he really wants to move away from austerity, he didn't do it in October, he did it for health. Health, that really was a shift in spending. Look at the total spending, it looks like a shift. But for all of those public services that aren't health, and to some extent defence. It's a continued period of spending falling as a share of national income. So he needs to find significant additional resources, and probably rather more than 11 billion, over the next 2 or 3 years if he really wants to make that big choice away from austerity. Let me conclude by saying something about where Brexit might or might not fit into all of this. Well, we know over the long term the GDP will be weaker and public finances will be weaker as a result of Brexit. That will eventually require spending cuts and tax rises. Either we have less good public services or we raise more money from the rest of the economy to pay for it. The scale of that, extremely hard to judge. 2 to 4% if we get something like the deal that we've got at the moment, or may have at the moment, significantly more than that on a no-deal basis. What might a no-deal Brexit mean in the short run? And this is why it's essentially almost impossible for the Chancellor to really be planning his spring statement next week with any kind of confidence, since it's right in the middle of the series of meaningful and meaningless votes about our future relationship with the EU. Now, there have been threats that if we get a bad Brexit, if we get a no deal, then that means there's less money around and therefore we get immediate spending cuts or tax rises, or indeed, if the Bank of England were to be believed, even the possibility of interest rate rises. Much more likely, what we'll get is more borrowing in the short run. Remember, borrowing is very low at the moment. We can afford more borrowing should we want it. Particularly if you think this is something which is really hitting the demand side of the economy. The reason I think even then this is not the same as the world we were back in 2008, 2009, when we really inflated the economy in response to the big financial crisis. Well, this time, if the problem is that there are real supply side constraints, if things can't get in through the ports, if we've got a real problem with the supply side, if there aren't things in shops, and given what we already know about the savings rate, we're not really necessarily going to be wanting to be pushing up consumer demand, if that's where the problem lies, because that will just stoke inflation. Now, my guess is that it will be judged at least that this is more of an issue on the demand side and that consumers do need supporting, but so one would expect some kind of fiscal expansion. But in the long run, there's no question about the fact that if we do get this kind of disorderly Brexit, then the long run impact will be higher taxes or lower spending. That is not, in the end, avoidable. I'm going to stop there. I think I've run about a minute over what I should have done. Let me just reiterate. First, don't forget, and it is so easy to forget, this has been an extraordinary decade already. Even ignoring Brexit, this has been an extraordinary decade. You then layer on top of that the uncertainty and the potential low growth as a result of, or both the continued poor productivity growth and the uncertainty around Brexit, and we are in danger of turning this into 2 decades of very poor growth, very poor income growth, and potentially poor returns. That is one reason already why I think the electorate isn't terribly happy. We're in danger of making them even more unhappy, and a worry for your clients is they'll be even more unhappy if there's no returns on their investment, because there's no returns in terms of growth in the economy. Thank you.
I'm sure we've memorised every one of those slides and we can ask questions about all of them. We've got a whole load of questions that have come in online, but if you've got a question in the audience, then put your hands up. We've got a few roving microphones wandering around, and we'll try to come to you as well. I just wanted to start off actually with, hopefully I think is a really simple one, and a point that I'd missed, which is this non-tariff barriers. Simple question, what is a non-tariff barrier? Can you perhaps just define that for us?
Well, I mean, a very straightforward way of thinking about a non-tariff barrier is if it just takes longer for a lorry to get, across from Dover to Calais or vice versa. At the moment, if it's within the EU, there's very little in the way of checks. You've read the headlines about the potential for, and I've no idea whether this is true, but huge traffic jams on the on the M2 or the M20, whatever it is. So that for goods, that's what a non-tariff barrier means, or an example of it. I mean, two things I'll say in addition. First, it's really important to understand about trade is that most of it is business to business. It is not French wine producers selling bottles of wine to us or Scottish whisky producers selling bottles of whisky to the French. It is car factories sending bits and pieces across from each other, or us selling financial services to firms in the EU. So that's the first important point. Second is, when you're thinking about services, trade barriers are all non-tariff barriers, because there aren't tariffs on services, and that is about standards and regulation and essentially whether you're allowed to do business. And that's why I said I think there's huge uncertainty in the numbers that I put up about the scale of those barriers for financial services, particularly, and services more generally. Also worth saying, when we're talking about the deal that Theresa May have, which is all about customs union, that gets around all of these problems on the goods side. It doesn't touch services.
Okay, so is anybody out there going to go first? Okay, somebody on the app gets to go first. And actually, there's a couple of questions that have been asked along the same themes. I like the language used in this one, so I'm going to use this one. If you were Chancellor of the Exchequer, which big bazookas would you deploy to fix all of this?
I hate that if you were Chancellor of the Exchequer questions. I mean, there's a reason I'm not Chancellor of the Exchequer. I mean, in the short run, it's very hard to know. There aren't big bazookas in the short run. I mean, my view about what chancellors can do is sort of, in a sense, quite simplistic, which is, in the short run, they can do much less than you think they can do, usually. If there's look at the productivity issue that I showed you. Is there much the Chancellor can do to fix that this year? No. Is there much that governments can do to fix it over a 10 to 20-year period? Yes. In the long run, there's more often that Chancellors can do than you might think. Whether that be all sorts of improvements to the tax system, or the transport infrastructure system, or the education system, or trade, or choosing where you build airports, all of these sorts of things, if you get those right, they can make a significant difference to things like productivity in the long run. Incredibly hard, actually, to make differences in the short run. In terms of the very short run and immediate issues, in terms of the choices the Chancellor needs to make this year, as ever, there are, how much should he spend? There are big trade-offs. But debt is high, 80% of national income, though debt interest is low. I would be surprised if he doesn't find more money than at the moment to spend on public services and other things. The last thing I'd say is, after 10 years of cuts, we are spending more and more on health. We have got demographic change. I find it extremely hard to imagine a world in 10 years' time in which we don't have tax higher as a fraction of national income than it is today. And we have some taxes that are falling, petrol taxes, for example, which we're not managing to get hold of. The thing that chancellors over the next decade are going to have to grapple with is how seriously do you increase the take from the tax system, almost certainly from big, broad-based taxes, in a world in which incomes aren't doing very well, and people are very happy to vote for things which suggest other people will pay taxes. That was essentially the Labour manifesto last time round, or nobody pays taxes, the Conservative manifesto, when the reality is everybody is going to have to play a part in that.
So follows from that, if they can't raise an awful lot of money through taxes, where's the low-hanging fruit from, if there is any? What's the lowest hanging fruit? Still might be very high in terms of raising money. Do you think pension funds are at risk of being raided?
I don't think there's a lot of low-hanging fruit politically. If one looks across one can make this judgment on two bases. What do other countries do? Well, there are two places that other countries get significantly more tax. One is actually social insurance contributions, particularly from employers. Now, it's not a terribly economically good tax, but that is what they do. The other is that we have the narrowest VAT system, I think, in the world, or certainly one of the narrowest VAT, in the sense of having no VAT on food, very low VAT on domestic fuel, and a bunch of other zero rates and exemptions. Now, we can't even put VAT on pasties, so the chances of significant expansion of the VAT system, I think, are poor. But if you look across the world, those are, the two places where other countries get much additional money. You look in the UK, the obvious place that and I do think there are places in the sort of pension payment system where we have a relatively wealthy generation of people of pension age at the moment who are paying no national insurance, for example, on their defined benefit occupational pensions, having paid none on the way in either. That's very generous. We have very large amounts of housing wealth, which tends to go almost completely untaxed, often even on inheritance, but certainly in terms of its growth in value. So we have things of that kind. Now, they're not low-hanging fruit in a political sense, but in an economic sense, they are at least there.
Okay. So unbelievably, we're almost out of time. Jamie's got a question at the front, so I'll go to Jamie. Jamie, can you stick your hand up again, because the lady with the microphone's running up behind you.
No, yes. Jamie Jenkins from Standard Life. Just a quick question. You painted, obviously, the picture of lower growth or in either a kind of deal scenario Brexit or a no-deal scenario Brexit. And obviously there's a kind of baseline that I guess is no Brexit and remaining as is. Do you feel now at this stage in the proceedings that we could return to that kind of baseline, or do you think some of the negative aspects that you built in there to the no deal are already kind of baked in and irreversible?
I'm not. Are you asking? Do you think we can stay in the EU, or are you asking something different?
In short, if we were to stay in the EU, do we go back to kind of your baseline graph, or do you think we've already kind of baked in now some irreversible changes that are negative?
Well, I certainly wouldn't want to comment on the probability of staying in the EU. I mean, I think two things. One, the Chancellor spoke in the October budget, and I think he probably will again next week, about the possibility of a, quote, deal dividend. So I think the argument that there's been all this uncertainty, and once we kind of get rid of that uncertainty, we've got a deal, and it's not as bad as it might have been, then investment and growth might pick up. I think that's unlikely, not least because, as I've said, the forecasts I showed are predicated on that outcome. And it also depends what your baseline is. That wouldn't be a dividend relative to staying in the EU. That might be a dividend relative to continued uncertainty, for example. If we were to suddenly wave a magic wand and say, let's forget the last 3 years and we're going to be in a world for the foreseeable future where we're in the single market and the customs union, I don't see why growth shouldn't pick up to its previous level as projected. Whether we would regain the lost ground, which I think is your question, I don't know. Remember, we didn't regain the lost ground lost after the last recession. Some of the lost ground has been lost because businesses have invested elsewhere. Some of it's been lost because they're holding on and maybe they would start to invest again. So I imagine some and some. Okay.
Well, I'm afraid that's all we've got time for. There were loads of questions on there. We could have spent hours chatting about this. Thank you very much, Paul. Thank you very much for your questions. Paul is going to be in the Learning Hub during the tea break that follows this session. So if you want to ask your questions, the ones you submitted over the app, then wander down there. It's in the exhibition hall, and he'll be able to take some more of those questions. Thank you very much for joining us. Thank you to those who joined us on the live web stream. Don't forget to give your feedback on the session on the conference app. Thank you, and see you after tea. Thank you very much. Well done. It was very interesting. There were